Hey traders, this is Travis from Master the Market. This is going to be the only chart patterns trading lesson you need. We're going to talk about the basics of technical analysis, some very basic chart patterns and chart formations, and we're going to break down how you can use these chart patterns to improve your own trading and consistently profit from the market. Be sure to give this video a like and subscribe to the channel, and without further ado, let's go ahead and get started. Now, before we start to get into some of the more advanced chart patterns themselves, it is important to understand that these chart patterns are essentially going to be made up of three main things. Those three main things being support, resistance, and trend lines. We have to cover each of these because they are going to make trading these chart patterns a little bit more simple and a little bit easier to understand how they affect the price of the stock. So first and foremost, a level of support is going to be a technical level on a chart where historically speaking the price rises from because of a higher amount of demand and a lower amount of supply. Remember that the stock market is going to fluctuate based on supply and demand. If there is a large amount of demand or a large amount of buying and a low amount of supply or a low amount of selling, that imbalance is what is going to cause the price to rise from that level. And on the other side of the spectrum, a high amount of supply and a low amount of demand is going to drive the price lower. So because these support levels are also known as demand zones, we will typically see a stock rise from a support level because of the amount of demand that is in that area. Now obviously I do kind of want to preface this by saying nothing is going to work 100% of the time in the stock market. So support levels are going to have breakdowns, stocks are going to break out above resistance levels, chart patterns may seem like they're going to break out but they end up failing. All of these things are going to happen from time to time, and that is why risk management is so important with stock trading. But all of these things also can give us an edge and can help us predict the stock market a little bit more accurately than we would be able to without them. Okay, so let's take a quick look here at this example diagram to give you an idea of what a level of support is going to look like. Generally speaking, it's just going to be a flat horizontal line where clearly the stock has bounced from on several occasions. We can use this because if the stock is consistently bouncing off that level of support, we know that most likely if it doesn't break down below, it's going to continue to the upside. So we can look to buy into that level of support and profit from the rise in price that follows. Now to apply that diagram to a real life example, let's take a look here at the stock IMUX. We can clearly see that there is a level of support right at about $9 per share. And I do want to mention that support, resistance, trend lines, anything based on technical analysis is not going to be to the penny. It's not going to be exact. So just because this appears to be at $9 does not necessarily mean that the support is invalid if the stock goes down to $8.99 or $8.98. There is going to be a little bit of wiggle room to the upside and to the downside when it comes to support and resistance. Okay, but we can see here that there are several opportunities here where the stock pulls back to this support level, has a little bit of a bounce to the upside, and then finally we get ourselves a higher low that forms above that support level, and it starts to have a bigger run up. I know it seems very simple, but support is one of the things that I base a lot of my trades off of, even as a full-time trader. And again, support levels are going to be a part of the foundation of almost every single more advanced chart pattern that we see in the stock market and that we're going to cover later on in this video. Moving on to resistance. Resistance is essentially going to be the polar opposite of support. It's going to be a technical level on a chart where historically the price falls from because of a high amount of supply and a low amount of demand. Resistance levels are also commonly known as supply zones, and they can provide us an opportunity to sell out of our positions before the price reverses against us, or we can look to short sell into these resistance levels to actually then profit from the pullback that follows. And another visualizer here to give you an idea of what a resistance level is going to look like. Just like a level of support, this is going to be a flat horizontal line. They are going to be pretty easy to spot on your charts once you see a stock failing to break above a specific level on several different occasions. That's going to be a resistance level, and that's going to be an indication that you should sell if you own a position to protect your profits and to prevent yourself from taking a loss once the stock starts to reverse back to the downside. Now here's a great example of a resistance level in Tesla. We could see that on three separate occasions here, Tesla spikes up into this $315 per share area. It fails to break above it, and finally on the third rejection of that level, we start to see a bigger pullback to the downside. It's always a good idea if you're in a position to lock in some profits, if not all of them, into a key level of resistance. It's a great way to protect your profits, and it can, of course, prevent you from being greedy. Alternatively, if you're someone that is interested in short selling, this also would have been a great opportunity to profit from this sell-off by looking to short sell up here into this resistance level, because as we know, a short seller profits as the stock price falls. Now, very quickly before moving on to the trendline section, I just want to remind you that a broken level of resistance can actually turn into a level of support. And vice versa is also true. A broken level of support can then turn into a level of resistance. So it's important to keep in mind past resistance and past support levels, because even though the price of the stock may have broken through those levels, doesn't necessarily mean that they're no longer going to be useful. So now that you know how support and resistance work, we're going to move on to trend lines, which are essentially just going to be slanted lines of support and resistance. A trend line is going to show us the overall prevailing direction of price by connecting the lows or connecting the highs. Now, in order for us to draw trend lines on our charts, what we're going to do is draw a trend line connecting the lows when the stock is making higher lows. So if we take a look at the diagram at the bottom, we can see that there are several different times where this stock is making higher lows. Overall, the direction is clearly to the upside. It's also making higher highs. So in other words, the higher highs and the higher lows are what is causing this stock to be in an uptrend. And when a stock is in an uptrend, again, what we do is connect the lows with a line, and that is going to then be our level of trendline support. We would use this level of trendline support the same way that we would use any other level of support, looking to buy here for the best risk and reward, and then cutting losses if the stock starts to break down below trendline support, because that would be a signal that the stock is changing then from an uptrend into a downtrend. Now, speaking of a downtrend, a stock is going to technically be in a downtrend when the stock is making both lower lows and lower highs. In this case, what we do, instead of connecting the lows like we would with an uptrending stock, we simply draw our trend lines by connecting the highs. So we can see with this diagram example, we have a lower high, another lower high, and then another lower high. We would then go ahead and connect those lower highs with a line. That line is going to then be our level of trendline resistance, which we can use the same way that we would with any other level of resistance in the stock market. Now, it's very important that it is going to be in your best interest to avoid fighting the overall trend. So if a stock is clearly moving in a downtrend, it's going to be very high risk for you to try to buy into these dips and then sell into these peaks into the trendline resistance. Instead, a better way to go about this would be to actually short sell into this trendline resistance, so that way the overall trend is still working in your favor, because that short position is going to become more and more profitable as the price of the stock falls. Very quickly, before moving on to the next section when we talk about bull flags, I wanted to mention that if you're enjoying this information and you want to learn more about day trading and investing, make sure to check out our Master the Market programs, which will be linked down below in the description. Alright, moving on to the bull flag chart pattern. The bull flag is one of the most used chart patterns for traders, and that is because it can be a highly accurate pattern, and it can be a really great way for you to take advantage of a stock's momentum. With that being said, the bull flag pattern is going to be a bullish continuation pattern, allowing traders to buy during a period of consolidation before moving higher. So simply put, when you're doing your technical analysis, all of the different chart patterns can pretty much be narrowed down to two main groups. We have reversal patterns and we have continuation patterns. Because the bull flag pattern is a continuation pattern, once the price is able to break out and confirm the pattern, that's going to indicate to us a continuation of the initial uptrend that started the pattern in the first place. Okay, and that is a crucial part of a bull flag. You have to initially have some form of an uptrend or some type of bullish move to the upside in order for a bull flag to even start to form. Okay, after you have that uptrend formed, the next thing that's actually going to make up this bull flag pattern is going to be a consolidation period with tightening price action. Now, that tightening price action is what is going to make up the bull flag pattern itself. You'll notice that the price action is starting to bounce around and getting tighter and tighter until it almost comes to a point and it needs to either break out or break down. Assuming that the bull flag pattern is successful, we will then see a breakout of the consolidation zone, and following that, we're going to see a continuation of the initial bullish move. So if we take a look at this diagram, this is going to give us a great idea of what this pattern is actually going to look like. We can see, like we just talked about, it's going to, of course, start off with an initial move to the upside or an initial uptrend. Following that, we're going to get that consolidation zone where the price action starts to get more and more tight and more narrow. Again, that narrowing price action in that consolidation zone is what is really going to make up the bull flag pattern itself. And then the third thing that we see with a successful bull flag is going to be a break out of that pattern, continuing the uptrend that initially started the pattern in the first place. Now the question that I'm sure you have is, how do you actually trade the bull flag pattern? It's one thing to be able to spot these chart patterns in real time, but it's going to be a whole separate battle to actually trade them properly in order to set yourself up for success with that specific trade. Now with the bull flag pattern, there are really two ways to actually enter into that trade. First and foremost, you have to kind of wait for that consolidation period to start forming a little bit, because without that, you're probably not even going to be able to tell that the bull flag is forming. But once we start to see that consolidation period, we start to see the price getting a little bit more narrow, we can look to buy into the dips near the trendline support, which is going to make up one half of the flag pattern itself. So these two arrows here show us a couple of dip buy opportunities to buy into this forming bull flag pattern. However, I will say that this pattern is not necessarily confirmed until we get a breakout above that trendline resistance and outside of the consolidation zone. And that's going to be our other way to actually enter into this trade. We wait for the stock to break out of that consolidation zone, which is going to confirm a breakout of the bull flag and is going to signal us that the price is ready to continue moving in the trend that it was moving before this bull flag even started to form. And I just want to say that we are looking at an example here on the 1 minute chart. So every single one of these candles is representing just 1 minute of price action. But with any chart pattern or any formation, you'll see them on 5-minute charts, you'll see them on hourly charts, daily charts, weekly charts, and regardless of the time frame, you're going to trade them the same way. The only difference is going to be that with a 1 minute chart like this, because it is such a short-term time frame, this is going to be a chart pattern that you would use for a short-term trade. If it was on a longer-term time frame like the daily chart, we would use that bull flag for a longer-term swing trade or maybe even a longer-term investment. But nonetheless, we would still look to buy in at the same points on the chart that we would if we were looking at an example like we see here with the short-term 1 minute time frame. Now, because we know what a bull flag pattern is, a bear flag pattern is going to be very easy to understand. It's essentially going to be the polar opposite, the same way that resistance is the polar opposite to support. A bear flag pattern is going to be a bearish continuation pattern, allowing short sellers to profit from the downward momentum. If you're somebody that prefers only to go long and you're not very interested in short selling, feel free to skip ahead to the next pattern, which is going to be the ABCD pattern, which is a great pattern for dip buying momentum stocks. With that being said, the bear pattern is very simple. It's going to start off with a downward move, the same way that the bull flag starts off with an upward move. Following that downward move, we're going to see a consolidation period where the price, again, starts to get more and more narrow. And then we're going to see a breakdown below that bear flag, which is going to signal a continuation of the bearish move. Now, like I said, this is mostly going to be used for short selling because it's going to be in your best interest to not fight the trend of a stock. And if the stock is clearly in a downtrend and it's forming a bear flag, it's not going to benefit you much by buying into that bear flag. And it's going to be a better option for you to actually go with that momentum and go with that downward trend by short selling the stock, which is then going to allow you to actually make money from the stock falling. So we can take a quick look at this diagram here and see again that this is very similar to the bull flag pattern, only it's going to be the opposite and it's going to be to the downside. We see our initial sell-off or our initial bearish move. Following that, we get our consolidation period, and then we get our breakdown below the pattern, telling us that the trend is going to continue to the downside. As a short seller, we would look to sell into the trendline resistance that makes up the bear flag, or alternatively, we would wait for the stock to actually confirm the bear flag pattern by breaking down, and we would short sell into that bearish move. Moving on to the ABCD chart pattern. The ABCD pattern is a bullish 4-step pattern providing a great risk-reward opportunity for dip buying in the stock market. Dip buying or buying into pullbacks is one of the best ways to trade momentum It allows us to get into a stock without chasing at the highs, and this chart pattern specifically is going to be a great way to buy the dip in a stock because not only does it make it very clear as to where you should buy the stock, but it's also going to give you a very clear level of risk, so that way you know exactly when to cut losses in case the chart pattern doesn't follow through and in case the stock doesn't move in your favor. Now, with all of that being said, the ABCD pattern is going to be made up of 4 points. Those are going to, of course, be A, B, C, and D. Point A is going to be the peak before the pullback. So once we see a stock spike up and have a big run to the upside, whenever it peaks and starts to pull back, that peak is going to be point A. Point B is going to be the low of that initial pullback. Following that, we're going to have point C, which is going to be a higher low that is going to form slightly above point B. And then last but not least, we're going to have point D, which is going to be a breakout above point A all the way up to new highs. Now I know without a visualizer that may be a little bit confusing and hard to follow, so let's go ahead and take a look here at this example diagram. We can see we're starting off with our initial move to the upside, and then of course we're going to get our 4 main points. We have point A, which is going to be the peak. We can see that we get a pullback from point A, and that's going to give us our point B there at the low. Afterwards, we're going to get that higher low that forms above point B, giving us point C, and then we're going to break out above point A, and that breakout is going to be point D. And these 4 simple points are what make up the ABCD chart pattern. And the way that we trade this is we're simply looking to buy the dip, ideally at point C. And the reason for that is because if we take a look here, point B is actually going to give us a very clear level of risk. If we use point B as our risk level and point C doesn't end up breaking out past point D, at that point we're only going to have a very small loss on our hands if we use the low at point B as our risk area to cut losses. Now additionally, the other way that we can look to take advantage of this chart pattern is to use point A, the peak, as our breakout level, and we can then look to buy into that point D breakout and essentially trade it the same way that we would trade any other breakout in the stock market. We know that a stock breaking out above a resistance level is a bullish sign for the stock, so that's why buying into this ABCD chart pattern breakout can also be a great way to take advantage of this pattern. Now let's go ahead and apply this to a real life example. We have the stock here, AEHR, and we're looking at the daily chart. So every one of these candles is going to represent 1 day of price action. Because of that, and because this is a longer term time frame, this would be an ABCD chart pattern that we would probably use for a swing trade or even for a longer term investment. Again, like I mentioned when we were talking about bull flags, you can find these chart patterns on any different time frame. The only difference is going to be that if it is a shorter term time frame, like the 1 minute chart for example, then that is going to lead to a shorter term trade. Okay, but with this daily chart example here, this would be a really great opportunity to swing trade, and we can see the 4 main points here are A, B, our C, and our D. We have our peak up here at a little bit over $19 per share. That's giving us our point A. From there we get a pullback. Once the stock starts to bounce back up, that is when we can really define point B down here at about $13 per share. And from there, we're just going to look to buy into a higher low that forms above point B, which is also going to be known as our point C. And we can see that we get that down here. It comes very close to getting back down to the point B low. However, you can see that it is slightly above that level, so it is technically going to be a higher low. And because of that, since it got so close to point B, this would have been a really great trade because we have a very small level of risk if we're cutting losses below point B. However, even better yet, we would not have to take a loss in this example. We can see that the stock bounces up from that higher low, ends up getting all the way back up to point A, and we actually then get our point D breakout, and we can see the stock is still running higher to this day. Now I do want to say that this is a really great example of why I personally prefer to trade the dip buy at point C as opposed to trading the breakout at point D. The reason for that is because we can see that if we're buying this dip down here at point C, even if the stock fails to break out at point D, there's still going to be plenty of room for profit before that happens. On the other side of the spectrum, sometimes if you're buying into a breakout like we do often with point D in this chart pattern, you do have to face the risk of potentially buying into a false breakout which can many times lead to you buying into the high of a move. At the end of the day, it's going to come down to preference as to whether you prefer to trade dip buys or trade breakouts. But either way, this ABCD chart pattern is going to be a really great way for you to find entries into some potential trades. Enjoying the video so far? Please make sure to smash the thumbs up button. Your support is much appreciated. And if you have any video ideas, make sure to comment them down below. If we choose your video idea, we'll give you a shout out on the Master the Market YouTube channel, and you'll also get 1 free month of Market Master Group access. The next chart pattern that we're going to discuss is known as the head and shoulders pattern, which is a bearish trend reversal pattern best used to sell or to short sell. Now, if we think back to when we were talking about bull flags and bear flags, I mentioned that pretty much any chart pattern that you can find in the stock market can be put into one of 2 categories. It can be described as a trend continuation pattern or a trend reversal pattern. Bull flags and bear flags, for example, are trend continuation patterns, but on the other side of the spectrum, the head and shoulders pattern is going to indicate a reversal from an uptrend into a downtrend. So let's go ahead and take a look at another example diagram here to give you an idea of what this chart pattern is going to look like. As I mentioned, the way that this pattern works is it's going to be starting off with an uptrend. Following that, we're going to get this bearish reversal pattern. And then last but not least, it's going to break down out of that pattern and start to actually downtrend. That is why we use this chart pattern as a sell indicator in the stock market. So if you may have a position and you see this pattern forming, that would be a good indicator to sell and lock in some of your profits before the price starts to move against you. Or alternatively, you could look at this pattern as an opportunity to short sell, so that way you would be able to profit from the bearish reversal that follows. Okay, but if we strip this diagram down to give you an idea of why it's actually called a head and shoulders pattern, realistically it is a little bit self-explanatory. If you look at this chart pattern, it kind of just looks like 2 shoulders with a head between. We can see our left shoulder, we have our head, and then we have our right shoulder. These 3 main points that make up the head and shoulders chart pattern actually give us a little bit more information than you may see right now. The highs that form at the left shoulder and the right shoulder, and the lows that form between the 2, are actually going to give us a level of neckline support and neckline resistance. These are going to be 2 key levels here for this chart pattern, because what we can do is we can look at the neckline resistance as an opportunity to sell, the same way that we can look at the neckline support as an opportunity to sell. These are the 2 main ways to trade the head and shoulders pattern. And if you think about it, this chart pattern is pretty self-explanatory, because if you think about what we were talking about back earlier on in this video when we discussed market trends and trend lines, the 2 things that make up an uptrend in the stock market are higher highs and higher lows. So as we can see here, if we take a look just at the first half of this diagram, you can see that this is clearly an uptrending stock. It's making higher highs and it's making higher lows. However, after the stock forms that head of the head and shoulders pattern, the right shoulder is really just going to be the first lower high that forms after a stock is consistently making higher highs. That's going to be a sign that the stock is switching from that uptrend into a downtrend, and from there a breakdown below the neckline support is just going to solidify that the stock is now making lower lows as well as lower highs. And that's why this chart pattern is such a highly accurate reversal indicator. Now to show you a quick real-life example of this, this is the 1-minute chart on SPY. We can see that this starts, of course, with a bullish move to the upside. We then get our left shoulder, we get our head, and we get our right shoulder. And if we go ahead and draw some lines here, we can see we have our neckline resistance as well as our neckline support. So again, the 2 ways to take advantage of this chart pattern is to look to sell either into the right shoulder resistance or wait for that breakdown to confirm below that neckline support and then look to sell or short sell in that area. In my experience, this is one of the most accurate reversal indicators in the stock market, so I do highly recommend to keep an eye out for this pattern and be very cautious if you see this pattern forming and if you currently have a long position in that stock. Alright, now the same way that support levels and resistance levels are essentially going to be polar opposites, and the same way that bull flags and bear flags are essentially polar opposites, the head and shoulders pattern and the inverse head and shoulders pattern, of course, are also going to be polar opposites. So that means because we know the head and shoulders pattern is going to tell us when a stock is reversing from an uptrend into a downtrend, the inverse of that, of course, is going to tell us when a stock is reversing from a downtrend into an uptrend, and that's going to provide us with an opportunity to buy into that stock and get in early before it starts to uptrend higher. Now, taking a quick look at the diagram for an inverse head and shoulders pattern, we can see again that this is going to start off initially with a downtrend. The stock is making lower lows and lower highs. And once this inverse head and shoulders pattern is confirmed and the stock breaks out above it, that is going to be the start then of an uptrend. The three main points making up this pattern, again being the left shoulder, the head, and the right shoulder, are exactly the same as they are with the head and shoulders pattern, only of course this is going to be inverted to the downside. We still have our levels of neckline support and neckline resistance, and those are still going to be the two key levels that we use to actually trade this pattern. The difference here is that with the inverse head and shoulders pattern, instead of looking to sell or to short sell like we do with the regular head and shoulders pattern, we're going to be looking at the neckline support as an opportunity to buy the dip in the stock, and we're going to be looking at the neckline resistance as an opportunity to potentially buy the breakout and to profit from the newfound upward momentum in the stock. Okay, so if we take a look at this real life example of the inverse head and shoulders chart pattern, this is going to be for the stock symbol AMD. And again, we're looking at the 1 minute chart. So this would be a short-term time frame for a short-term trade, most likely for a day trade or even for a quick scalp trade. We can see pretty clearly that we have our level of neckline resistance as well as our level of neckline support. And really this level of neckline support is essentially just going to be the first higher low that forms after the stock has been in a downtrend. So we can see it is consistently making lower lows, and then we get that breakdown here at the head. And finally, this right shoulder of the inverse head and shoulders pattern is going to be the first higher low that forms, telling us that the stock is now essentially switching from a downtrend into an uptrend. And we get a confirmation of that once the stock breaks this neckline resistance, and it starts to then continuously make higher highs and higher lows, showing us that the buyers are now in control and the momentum is to the upside. Thank you for watching, and remember to give this video a like and subscribe to the channel if you enjoyed. If you want to learn more about day trading, swing trading, and even long-term investing, make sure to check out our exclusive education and our daily trading group at our website, Master the Market, which can be found linked below in the description. Thanks again for watching. I hope you enjoyed, and good luck with your trading.